Hey everybody, this is Tom Nash, and you're probably wondering what's going on in today's stock market. I mean, we started off the day with a completely normal looking market, and we ended up with a crazy X. Absolute insanity, scratching your cars with their keys. What happened today? Well, first of all, don't panic. Everything is fine, but let me explain why the market took such a dump today all of a sudden. Well, there's really two things that happened today. I'm going to start with the first, and then I'm going to move on to the second. The first was the retail data came out, retail sales data came out, and it came out great. 0.7% increase, which is way better than the expected 0.3%. And they actually revised to 0.9, the previous one. So you would say, well, this is great, Tom. Retail sales is great. People are spending money. That's good for the economy, right? Why would the stock market dump in that scenario? Well, you have to understand the very delicate dance that we have right now with the Federal Reserve. Essentially, if we want to get rate cuts for the market, we need the Fed to be pressured to cut rates before they break the economy. As long as the economy stays in great shape, which means low unemployment, which we got right now, which means great retail sales data, which means people spending money, which we got just right now. In fact, people are spending way more money than we thought, 0.7 versus the expected 0.3. As long as the economy is doing great, the Federal Reserve does not feel the pressure to cut rates because cutting rates is very dangerous. It's very risky. If they cut too soon, inflation is going to come back. And they don't know exactly where the too soon part is. And as long as the economy stays strong, they have more of a safety region, of a safety net to wait. And the Fed has already indicated that as long as the economy stays strong, they're not going to be under any pressure to cut rates ahead of time. So since we just got really good economic data, people are spending money, low unemployment, the theory is that if the inflation is stickier than we thought, which is what we had in the last CPI, and the economy is better than we thought, the Fed is going to take its sweet time before they kind of cut rates. That essentially solidifies the expectation of going from 3 to 2 cuts towards the latter half this year. Essentially, we went from 6 cuts in the beginning of this year, then to 3 cuts. And now, based on today's data, the expectation is 2 cuts in November and December of 2024, not before. So really completely different kind of almost counterintuitive situation. Retail data comes in great, inflation expectations, and then everybody sells off because higher interest rates for longer means valuations will come down. So that's part one. But that is only half of the equation. On the other part of the equation, today was also a shift in geopolitics. As you may have heard, there's something going on in the Middle East. The Iranians essentially launched a missile attack, a drone attack, hundreds of missiles, hundreds of drones to the Israelis. They ended up hitting nothing. So the Israelis shot everything out of the sky, but they did end up, launching 400 missiles from Iran to Israel, and the Israelis were pissed. Now, once that happened, it completely kind of sent the market into this craziness because this was a very well telegraphed in advance attack, right? The Iranians basically said a week in advance, this is what we're going to do. Just so you know, we're going to attack the Israelis. This is how we're going to do it, etc., etc. So they telegraphed the whole thing in advance. And that is why on Friday, before the market closed, everybody and their mom sold off their stock portfolios. You've seen a great dip on Friday because people were saying, well, Iran is going to attack. They've telegraphed the attack. So it's time to get out of the market. It's going to get bad, right? The attack happens, but the Iranians miss. Somehow they missed 400 times. And, as the hours go by, the minutes go by, and the Israelis did not respond, people were starting to say, well, look, nothing really happened. They didn't really hit anything. So the Israelis are probably not going to respond. So they haven't responded on the eve of the attack. They have not responded on the next day after the attack. I mean, that's it. It's done, right? They're not going to respond 3 or 4 days. And then we had some reports that the U.S. government is pressuring the Israelis to not respond and whatnot. And the day started off with this understanding, well, it's all news. The Israelis are just going to let it go because they basically dodged the bullet, right? But then all of a sudden, while the retail data comes out and, punches the market in the belly, all of a sudden the chief of staff of the Israeli military comes out and says, you know what, we thought about it and we're going to retaliate. And we're going to retaliate very hard. And we're going to inflict some pain on the Iranians for what they've done. And we don't care what the response is going to be. We're going to retaliate. So don't think we're just going to sit here and take it. So immediately as that happened, the markets basically said, well, You know what? Israel is going to retaliate, which means we're going to have a higher potential of a regional war in the Middle East, and if the Israelis decide to strike any of Iran's energy infrastructure, or if Iran's decide to strike any Western energy infrastructure as a retaliation, as the whole region is headed to regional war right now, oil prices will probably climb up, and supply chains will probably go to shit. And this whole war in the Middle East is going to make things a lot less, accessible. It's going to push oil prices down. It's going to push inflation up, et cetera, et cetera. So the whole hope of a lower inflation, basically, if there's a war in the Middle East, oil prices is going to, kill that whole narrative. So people took 2 and 2 and they got 4. Essentially, war in the Middle East is about to erupt, and the economy is way too strong for the Fed to cut rates when the inflation data is just too sticky. And they sold off. I mean, what did you expect them to do? I'm not a trader. I'm not a short-term trader, but I mean, it's a logical thing to do if you're, a day trader or a really short-term trader, and that's fine. Now, as you would expect, today you've seen kind of a flurry of opinions from both sides of the aisle. Obviously, you have Tom Lee, who jumped on CNBC today, and he was talking about the fact that he sees still his original target for the S&P 500 unchanged, and essentially saying, well, look, we still believe the Fed is going to cut rates, and there's still $6 trillion on the sideline. And even if the Fed does not cut rates and the economy numbers are high, we're still going to have great earnings, and great earnings is going to push stock prices up. So we don't see any problem as long as the Fed doesn't sabotage the economy by hiking rates all of a sudden. So Tom Lee is still bullish. Others are not as bullish. We have Jamie Dimon, we have Larry Summers. Now, my 2 cents about it are very simple. If you go back to last week, CPI data comes out, it's hotter than expected, markets drop. PPI data comes in, it's a little bit cooler than expected, markets climb a little bit up. War in Iran starts reporting up on Friday, people sell. Then Monday comes in, everybody's saying, well, Israel didn't really retaliate, everything is fine, let's keep buying. Market becomes slightly green. Then economic data comes out. It's way better than expected. Now we know the Fed has way more of a cushion. They start selling. Then all of a sudden the Israelis are saying, well, we're going to start a war in the Middle East. Not really, but they're essentially saying we're going to retaliate. That increases the war in the Middle East, increases the potential of an increased price of energy and oil, which increases the likelihood of higher inflation numbers, which decreases the likelihood of rate cuts. So markets sell off. Natural progression. Now, here's the thing though. These things are not stagnant. They're not static. This is moving very fast. Anything can change. Larry Summers, the guy who's in the bear camp, literally told you this a week ago. He said, look, based on what we know now, this is the pathway. Right now, the pathway isn't good. But in a week, data can change. Inflation numbers can change. Geopolitical stance can change. The Israelis and the Iranians might squash it. They might not. Who knows? And when you look at this, you have to make a decision how you're looking at this, through which glasses. If you're a trader and you're looking at this, that's one thing. I'm not. I'm a long-term investor. I'm looking at this and I'm saying, one more day in the office. I'm looking at the next 10 to 15 to 20 years. That's just one day out of the next 7,000 days. Who cares? I don't sell and I don't buy based on geopolitics, based on inflation expectations. None of this. I stay the course. I DCA. In fact, when we have days like this, when we have weakness in certain stocks, which I may like, I'm actually buying a little bit more. I'm increasing my dollar cost average. And that's something we teach exactly on our Patreon. How to identify the weakness areas in which you want to double down. How to identify the areas where you want a little bit slow down. How to manage these processes. So at the end of the day, when you look back in 3-5 years, you have a very low cost base without actually timing the market. Check it out. Patreon.com/Tom Nash. And of course, you're more than welcome to join our community over at Discord, discord.gg/Tom Nash. We're almost at 10,000 people. If you can get us to 10,000, that's going to be amazing. We're going to throw a massive party. This is where we talk about everything. You definitely want to be a part of this, especially since it is 100% free to join. And as always, if you haven't yet, I've built a platform that will help you analyze any stock for any retail investor. You don't have to get Bloomberg. You have to get none of this professional stuff that costs lots of money. We built a platform that allows you to analyze any stock. Look at the financials. Look at the trends. Look at the DCFs. Look at the 5-year pricing plan. Look at what analysts are doing. Look at what insiders are doing. Everything. It's a platform we built because we are retail investors for you, the retail investors. It's called Stock MVP, stock-mvp.com. You can get it for 1 week for free. Try it out. See if you love it. I'm sure you will. And if you don't, you get your money back. Simple as that. In fact, we won't even charge you for the first week. I just remember this. Now, if you lasted all the way to this point in the video, it means you deserve the coupon code TOM25. 25% off for your lifetime of use and no price increase at all. Unlike the Fed, we're not going to raise prices for those who use this code. We'll see you in the next one.